you guys doing? All right, so we're moving forward with risk related to fixed income portfolio or when you invest in bonds. And we said that when you invest in bond, there's a lot of risk, but we're mostly concerned in this class, there's two type risks. One risk associated with interest rate movement, and the second type of risk is default risk. And in the previous lectures, we talked about Macaulay duration, and we talked about modified duration. And in this lecture, we can expand on to convexity. So in the previous lecture, we said that Macaulay duration is the summation of the present value sub I, PV sub I, divided by the present value. And we said this is the present value weighted on time. And this is really the price of the bond. Now, what is the practical question does Macaulay duration answers? It answers the question, how long does it take to recoup the initial investment that the investor outlays? So Macaulay duration answered the practical question of how long does it take for the investor to recoup the money that they outlay upfront. And Macaulay duration give us an answer in time, mostly in years. So 4.8 years, 5.6 years, whatever it is. Then we said, well, Macaulay duration in the business world on Wall Street, when you hear of duration, they're not really referring to Macaulay duration unless they explicitly said so. Usually they refer to modified duration. And modified duration, it takes Macaulay duration and divide it by 1 yield to maturity over N. And we said that N in most cases is 1 or 2 because the cash flow bonds usually annually or semi-annual. And we said this formula answers the question in the practical world of if interest rate moved by 1%, how much is my percentage gain or loss? So Macaulay duration answered the question, how long does it take for the investor to recoup the money they upfronted? Modified duration answered the question, what is my percentage gain or loss if interest rate moved by 1%? And we said these are two, in order for you to get the modified duration, you need to calculate the Macaulay duration first to do it. There is another way, they call it, and it's faster, it's the approximated modified duration. And the way we calculate that is V minus, which is when the bond, the interest rate goes down, the price goes up, minus V plus divided by 2 V naught delta yield to maturity. So when interest rates go down, the price of the bond increase. It's an inverse relationship. Subtracted from that, when the price of the bond goes up, divided by the initial price time yield to maturity. So they call this the approximated modified duration. Approximated modified duration. Keep in mind they come in different flavors and different notation in the textbooks. So you may hear of it as the effective duration. But if I'm here in this class, I'm just introducing it to you as the approximated modified duration. Because if I call the effective duration, then I have to adjust for and account for embedded option in the bond, like callable option. And this is beyond the scope of this class. Here is investment analysis, and I'm approaching it from measuring and thinking about the risk. If you go to fixed income class, they will expand on this. Now, once we arrive to this, we try to calculate delta change to price and equal minus modified duration time delta yield to maturity. And I said to you in the previous lecture that this is negative slope because the relationship between the price and the duration is a straight line and it's a negative slope. Now, if delta change is positive, this is going to be positive, this is going to be negative, it's going to reduce it. If delta change is negative, negative time negative would be positive, it's going to increase it. Now, this is where we stopped in the last lecture. Sort of. Then I said, well, when we try to calculate this, we find out there is a gap between our estimate price based on this calculation and the actual price. Because keep in mind, this is an estimate and we can calculate the actual price and we find there is a gap. And the gap is due to the relationship between price and yield to maturity. So the relationship is sort of, my writing, my drawing, terrible, but let's say I'm gonna deal with it. Okay, so the relationship here assume a linear relationship. So this is the yield to maturity, assume it's 6%, and this is the price of the bond. Now, if the movement is a small movement, so let's say the interest rate change by 10 basis point, and it's annual paid, so maybe it's going to be somewhere around here, and this did around here. So the relationship, when you use the delta price, it's sort of not too far off. But when interest rate change, but at least a point or so, then we're going to find out there is a mispricing. So here is the rate 27, here is the rate down to 5. And we're going to find out that the linear relationship is trying to estimate the price right here for the bond. But the actual price on that convex line is right here. This space, we call it convexity. So the relationship between the interest rate and the bond price, it's a convex relationship on this line, on this graph. When we use this formula, or the approximated modified duration, is we're trying to anticipate in the future or to answer the question that your investor asks you, what would happen to interest rate? What would happen to my bond if interest rate increase or decrease by 1%? So this is the question we were trying to answer. Now, and we find that it's a linear relation and it's a negative slope, but the actual relation, it's convex, and we're missing this part. So you could say this is the first order, and here convexity is the second order. So how do we calculate convexity? We'll calculate convexity or the approximated equal V naught, or I'm sorry, V minus plus V plus minus 2V naught divided by V naught times delta yield to maturity squared. Now here, it could be different notation. You may see it with 2, or you might see it with not, we don't have a 2. But if you put a 2, I'm going to tell you what to adjust for in the second step. If you don't put 2, what to adjust for. But you have to follow either way. They both are correct. So here I'm not putting 2, okay? So if you see it in the different textbooks, it's not a mistake. I'm adjusting for it here. So the delta change to the price would equal minus modified duration time delta yield to maturity plus, this is the rest of the problem, the equation, half. Now, if you don't put 2 here, you put half here in the adjustment. If you put 2 here, you don't put half there in the adjustment. You guys got that? It's the same thing. So if you adjust for it here and you put 2, you're not going to put half convexity time delta yield to maturity squared. It's the second order. Now, by applying this formula, we're trying to capture and answer the question. Read that formula out of here. Let's see it. Delta change to price equal minus modified duration time delta yield to maturity plus half convexity time delta yield to maturity squared. And John, again, you put half here if in your calculation you did not put 2 here. If you put 2 here, then you don't put the half here. So not to avoid confusion, I'm just going to go this way. So this is the formula. And I'm going to give you the actual time, right? I'm just giving you a rundown with the story. Okay, so again, not to get lost in numbers, what are we trying to answer in a practical application? What we're trying to answer is when interest rate change, it impacts the price of the bond, and it has an inverse relationship, but does not impact all bonds equally. You with me, Josh? So if it's a bond with a longer maturity, it has higher duration, higher risk than a bond with shorter maturity. And if it's a bond with a smaller coupon, it has bigger duration or bigger risk than when with a bigger, it's the reverse, with a bigger coupon. And if interest rate change. So these are 3 variables. You cannot go to your client and say, if this happened and this happened and this happened, you give him 3 variables. One answer, capture the 3 variables, which is duration. So duration, capture the 3 variables in one number. Because again, there's a difference depending on the maturity and depending on the coupon and depending on the yield maturity. All these variables, they impact differently. So you need to have one variable that you can give to your client and capture these three variables, which is duration. Guys, just be aware when you are calculating the change in the price, it's the modified duration, not the Macaulay duration. When people talk on the street, they are referring to these two, either modified duration or approximated duration. Because this is answer the question, if interest rate is changed by 1%, what is the impact on my bond price? And keep in mind, we're trying to address one question, bond price and a change in interest rate. There is another risk that we're not capturing here, but I'm just gonna mention it to you. It's the reinvestment risk. Reinvestment risk, Kevin, mean this is the price risk. But what are you gonna do with the money you take as a coupon payment, right? Because the money you are going to invest and have the opposite desire. Because if you're collecting the coupon, you're going to invest this coupon, you want to actually be able to invest that at a higher rate. But here, higher rate, when the rate goes up, it impacts your prices. So you have to be mindful, we're only capturing one risk. You with me, Zach? We're capturing only price risk. There is another risk, it's the reinvestment risk. When you got the money, what are you going to do with it, right? Okay. So let's expand on the idea and see how I'm gonna explain it more to you in numbers, but I thought to give you the rundown before we got caught up in numbers. Now, the test for the final will be on this date, same location here. And I'm gonna talk about the test when we got close to the test, okay? But I just want you, this is the date, and it's gonna be here. Here, assume all else equal, which bond is more sensitive to interest rate changes? Bond A or B? What do you guys think? What do you guys think? Assume all else equal, which bond is more sensitive to interest rate changes? Bond A or bond B? Here, this bond is 20 years, and this bond was 10 years. Based on our discussion, which one will be more impacted? Longer, right? The one was longer, right? But when it comes to the rate, it's the opposite, right? Therefore, you cannot tell. Hence, you need to have a duration to answer the question. To capture the most opposite dynamic. You guys got what I said? Okay. So now you know why we need a duration in the practical application to give us better answer. And keep in mind, I did not add the interest rate there. Now I'm asking another question. Based on this learning objective and learning that you're doing in the class, if you were to construct today a fixed income portfolio, would you construct one with higher or lower duration and why? It's based on management skills. Now you're getting the learning, right? Assume you are today as a manager and you manage in a portfolio and you heard and you've been hearing this discussion in the classroom. Which one would you construct? One with longer duration or shorter duration and why today? Anyone?
Maybe one with longer duration, that way I don't have to be invested.
Okay, Freddie said one was longer duration because?
I don't, if I want to have to make them assets of like when to be invested.
Okay. What do you think, Kevin?
I think a mix of both. I feel like it also depends on what your risk tolerance is. So with like a longer duration, you're obviously bearing more risk and the interest rate's more sensitive. So I feel like we need to both.
Mix of both. Okay, John, any thoughts?
I don't know what Kevin said, if you have a higher duration, it's more sensitivity. So I guess it makes it both. So if you have higher, if it's doing well, you're good.
Okay. Zach's. Okay, so let's go with the first Zach.
Really depends on this time.
First Colin. Okay, assuming, so you see him, you guys see him like, okay, you're talking about risk tolerance. What's your forecast about interest rate in the future? Is it going to go up or down? It's going to go?
Down.
When I introduced you to the yield curve, right? And the yield curve, Zach, was inverted because the market, John, think interest rate now is high and it's gonna go down in the future, right? So if you think interest rate is going to go down, should you construct a portfolio with a longer duration or shorter duration? What do you think?
Longer because if it's more sensitive, the price would go higher.
Right. You guys get it? We're good? Because again, if you believe interest rate in the future is going to go down and you have a portfolio with a longer duration, hence when the rate goes down, you're gonna get to benefit. Right? But again, to your point, and Angela, if the interest rate doesn't, then you are a bigger risk. But again, it's a risk and reward trade-off. But again, we introduce it to the yield curve. Everybody in the whole world think it's inverted. It's going to be shorter than today. Therefore, today, I would, and again, this is my personal decision, this is like the classroom discussion. We should have a longer duration portfolio today based on this expectation.
Can you explain why you would benefit from having a longer duration again? I don't really understand why.
Yeah, you remember when, in the last lecture, when I said if you have a duration was 4%, portfolio was a 4% duration and interest rate to change by 1%, you gain 4% gain, right? If you have a duration was 10, you got 10% gain, right? You guys got it? So higher the duration, because we said if interest rate to change by 1%, how much you got to gain or lose, right? So if you have a 4% duration, that's 4% gain. You have 10% duration, longer duration, that's a 10% gain. So you're better off with 10% gain than 4% gain, right? Of course. Okay. This question has nothing to do with anything, but I want to, how is the assignment? The last question on the assignment, did you guys hear her out? Very practical, very practical. That's why I listed it there, because I feel this is things happen all the time. I witness it, and I asked a chat GPT, because I knew you guys go visit once in a while, right? And I told you can use it as a reference, but never put it there on your own finding. Okay, what does it take? What is the qualification for investment banker? And of course, education, that's why you are here. Financial knowledge. I'm mostly concerned with the second and third and fourth question. Analytical skill and quantitative skills. So if I'm giving you some numbers here, is not to torture you, because it's part of the requirement in the future, right? Part of the requirement for success is to be able to crunch some numbers. Right, guys? And keep your eye on details. So it's no mean by it's a torture, it's a development. It's the most desirable, actually, attribute for a candidate for a job. Okay, let's listen to part of this.
Thank you, Senator Kennedy.
Situation.
Okay, this is gonna be on the test, and I'm dead serious. So pay attention,
And then
because I'm not gonna ask you what she said, right?
It is an improvement because it raises taxes by more and, it needs to.
That includes taxes. In what world is that an improvement? Other than Washington and law management?
It's an improvement in that the revenue.
The question I
increases
want to is that
far
when the actual time.
exceed proposed investments.
Okay. All right, let me ask you this, isn't it a fact that, in January of 2019, the Federal Reserve issued a warning to Silicon Valley Bank over its risk management systems?
I have no idea. I'm not responsible in any way.
But you're in charge of the banking. bank,
She used to be the chairman for the
right?
bank,
I
right?
am
She's
not
the
involved
treasury
in
secretary.
banking supervision, and I don't have access to any information about the supervision of Silicon Valley Bank.
Okay, so you don't know whether or not the Fed, you haven't looked to see whether or not the Fed issued a warning, 4 years ago to the bank over its risk management systems?
That's not public information, and it's not
It is, the Wall
information.
Street Journal.
Well, it may be in the Wall Street Journal, but it's not public information, and it's not information that I have access to.
Well, I'll give you a copy of this article.
I've read the article, but
The Fed issued a matter requiring attention. And it said your risk management practices are terrible and you need to improve.
that is what the article says.
Right. Isn't it a fact that, months before SVB went under, that, the bank disclosed that its mark-to-market value of its bonds was $16 billion less than their balance sheet value?
They did make such a.
This is what started the problem.
Did the people at the Federal Reserve just
Did
not
announce
believe
it.
I'm not at the Federal Reserve.
I know.
I was at the Federal Reserve.
You're the
So lost
treasurer.
16
I mean,
billion
you're in charge
because of
banking, right?
interest rate change in price.
Let me ask you,
And I'm in charge of the supervision of the bank.
let me ask you this, Senator Hunter talked about the, 2018 amendments to the Dodd-Frank Act. Isn't it a fact, now, SVB was not stress tested in 2022. 34 banks were. Here's the Fed's report. Isn't it a fact that if SVB had been stress tested, it would have passed?
Stress tests look at capital of the bank.
Here's yes, ma'am, under the stress test, isn't it a fact that SVB would have passed?
I don't know. It wasn't
So
stress.
you need to look into that, Madam Secretary.
This is not my job. This is the Federal Reserve's job.
Okay, isn't it a fact that when the Federal Reserve stress tested in 2022, it only stress tested credit risk, it didn't stress test duration risk? Isn't that a fact?
I believe the stress tests in general partially address and take account of interest rate.
No, ma'am, I've read it. Here it is, bigger than Dallas.
Well, to the extent that there are assets held in an available for sale portfolio that would suffer losses due to changing interest rates, that would be captured in the bank's.
No, ma'am, it's not there.
Okay. So when you become a CEO, and some of you will, just make sure that you account for duration risk so you don't get grilled on the Senate floor. Right? She's a Treasury Secretary and she used to be the chairman for the Federal Reserve Bank. And they really related, they're supposed to have a firewall between them, but we know they're related. One brings the money and one ordered it to bring the money. Okay. In finance, do not round intermediate steps. Right? You guys should know that by now, and I'm putting it there, especially when we calculate duration and convexity. Do not round. By the way, today's lecture is on Canvas. If you want to download it so you can follow along.
So when we're calculating the present value for each of the cash flows, when we're calculating the duration, should we put the whole number or round?
When you have the final number, Kevin, you give me, you can round it. But at in the process of arriving to the final number, keep your calculation set to 9 decimals. Okay. So here is sort of the graph I listed for you here. That when we calculated the delta change to the price based on modified duration itself, we capture this part, but and we assume it's a linear line, but the reality it's a curvature, and we did not calculate the second order effect. Therefore, we need to account for it in our calculation. So John, last lecture, you're asking me what happened to the rest of the part. I said to you, we didn't cover it today. So we're gonna cover it today, right? And make sure, you guys, that your calculator is working fine, and you set it to 9 decimals, right? In fact, it seemed last lecture, there was something, Angela, you're asking me about these two numbers, and for somehow when I put my emulator into the desktop, it reset it and it messed up some of the number. So you're asking me, how did I arrive to these numbers, right? And for some reason, my calculator was like have a hiccup, and I couldn't give you the same numbers, right? Or were acting up because I was looking why. So just make sure that your calculator is good. You guys can always say second and future value to clear all your past. Second and future. Make sure that this is your best friend in the test calculation. You set the second and future to clear all data. You want to see if there is something carry on, recall IY, so it's 0, recall PV, it's 0, so we're good. So Angela, you're asking me, I said to you verbally that this number was like the return on investment. This was the price, this is the new price. You subtract this from this and you divide it by the start price. So it's $1,000 minus 913.06 equal, this is the difference between this to this, and you divide it by your initial investment, like you calculated the return on your investment. So you divide it by the $1,000 that we started with, and it's 8.694, right? So this is the change. You do the same thing to the other side. So the other side will be 1102.73 minus $1,000, that what we started with, equal, and divide that by the start point, which was 1,000. So it will be 10.27, right? Okay, I just want to make sure, even the look of the calculator you see is different on my desktop than on my laptop because it's an emulator. I have to plug it in, whatever. I guess it goes back to the manufacturer and they reset it last time when I was doing the lecture. So let's go back to today's lecture. So here's a question, and let's do some practice on this question. So assume a fixed coupon bond with 15 years remain to maturity, and it's 8% annual coupon rate. 8% annual coupon rate. Its current yield is 7.4. If yield to maturity changed by 1 basis point. So this is the given. Interest rate to change by 1 basis point. Calculate the following. Three requests. The approximated modified duration, the approximated convexity, and what is the delta change in the price if yield to maturity increase by 1%. And this is the formula I'm giving you, and you already see them on the board, and you should be comfortable with them now. So the approximated modified duration is this formula, the approximated convexity is this formula, and the delta change in price, this is a percentage, by the way, it's the minus modified duration times delta yield to maturity, half convexity. I'm using half because here I'm not dividing by 2 times delta yield to maturity squared. So how are we gonna test this question? And the emulator sucks. Keep going. Yes, sir. Did you read the question?
I was gonna say, are we going to do this question?
Yeah, let's do this. Again, I want you to practice, right? How we're gonna do these number and these calculation. Guys, on the test, I will ask you some of these problems, right? And you're gonna get the homework and it's gonna be part of the test and it's part of the learning. So I want you to practice. The best time to practice is now, so we can do it together. So the question is asked, what happened if interest rate is changed by 1 basis point, right? Calculate the changes. So here, the future value is 1,000. So maybe you want to follow along with your calculator. The maturity is 15 years. That's N. The IY, the coupon rate is 8%. I'm sorry, the coupon rate is 8%, so the coupon payment is $80. And it's 7.4 is the IY. And compute present value. So the present value at V naught at the start is 1,053 and 293. You guys see that? Now on your calculator, it said, well, what happened if the interest rate is changed by 1 basis point? By 1 basis point, and based on, because this is an annual base, so we're just gonna apply that based on an annual base. Keep in mind, if the payment is semi-annual, you need to divide by 2, right? But this is based on an annual base. So the 7.3, when interest rate goes down, it's gonna be, to calculate V naught, V minus, you use 7.3, which is 1 pips down. So it's gonna be 7.39. And this is the only thing we're gonna change in the calculator. IY, compute present value, is going to be 154,215. You see that? So let's calculate the V plus. What is it? Best time to practice is now, guys. Show me, tell me, involve me. So, okay, what we're trying to measure? What happened when interest rate is changed by 1 basis point? Calculate the approximated duration and calculate the slope of that line, what is going to be. So here, this is the yield to maturity, and this is 1 basis point, by the way, in percentage. In decimal, and I've been telling you this before, in decimal, is you move it, to change it to decimal, you move it by 2. So you jump 1, 2, and you put the dot sign here, or the period, so that would be 3 zeros. But we'll get to it as I show it here. So what is the V plus, guys? What is it? 1,052. Okay, so the rate is going to be 7.41 IY, compute present value, 1,052,372. Now we're going to take these variable and we're going to plug them into our approximated modified duration calculation. So it's going to be V minus, which is again when the yield went down and the price increased, minus V plus, the one we calculated. It's going to give us 1.843 divided by 2 V naught, yield to maturity. It's going to give us that variable. Then we figure out the change to the price. And once you plug in this number, it's going to be this is what you should arrive to. So it's telling us that if yield to maturity, it changed by 1 bip, or the approximated modified duration in general is going to be 8.74. And this is the slope of the line, and I put it there negative because it's a negative slope line. Now, if we plug in these numbers, now the second question, so this is the first question. The first question asks, calculate the approximated modified duration. So now we calculated it. The second question, what is the approximated convexity, right? We answered the second question. So this was the first question. The second question, what is the approximated convexity? To answer the approximated convexity question, we're gonna need to apply the approximated convexity calculation. And it's right there on the board, and you see it here. And again, I'm just using the one with nu 2. So it's a V minus plus V plus minus 2 V naught divided by V naught time yield to maturity to the second power. These variables should already be in your calculator, and you already calculate them before. And the only variable we need to have is the V minus, which is the same guy here, right? 1053. It's going to be the same guy here. So now convexity is 94.94034. Are we good, guys? Do we know what we get these numbers from? Anyone does not know what is each number represent or what is it derived from? Again, this is on Canvas, and you can download the slides to follow along if you want, right? Here is what mistakes can happen, that it's 1 basis point and you don't add for the 3 zeros. Again, 1 basis point is 1%, 1/100th of 1%. And to make it to a decimal is you move 2 zeros and you put the period. Anything 1% is 1. To make it to decimal again, you move 2, right? And become 0.01. Okay, so anyone does not know? So this is really, it is the V naught, and it's the same value here. So you just multiply it, and now we have the convexity. Okay. So the next question is we need to, and again, this is the formula. If you like it typed and neat, so the formula is here, and we arrive to the convexity. So the third question is asking, what is the delta change in price? And we said the delta change in price is minus modified duration, time a change in yield to maturity, time half convexity, time a change in yield to maturity squared. The formula right here on the bottom, on the one I mentioned earlier today. So it's just a matter of plug and play, put the numbers given into the formula, and you will be able to arrive to the percentage change in price, percentage change in price. So here, this part was derived, and it said here, what is the percentage change in price if interest is changing by 1%, right? So now it's by 1%. When we did the initial calculation, to arrive to this, we use 1 basis point. To calculate it by change based on 1%, that's the 1%. If it changed based on 10 basis point, it's based on 10 basis point, right? So this is the third question. So the third question was, what is the percentage change in price if interest rate change by 1%? So we took this number from delta change in 1 basis point, and we multiply now by this for the 1% change. Here, the yield to maturity 1, and we're applying this part, which is the half convexity that we calculated, times the yield to maturity to the second power.
Why is the 0.01 in percentage and not in like 0.000?
Yeah, this is the whole 1%. You're talking about this number.
Yes.
How else it should be? This is in decimal, right? This is 1%.
Wasn't it before?
Now, one before that was 1 basis point.
It changed.
Yeah, the third question was asking you calculated based on 1 basis point, right? So the second question, you did your answer based on 1 basis point. See, once you arrive to this answer, it becomes fixed. This is based on 1 basis point. let's say based on 10 basis point, that's become, it's a fixed number, right? And become whatever the number given, time that number, right? So now based on 1 basis point, one interest rate, which is 100 basis points, right? Is 1%. Before was zero, this was 100ths of 1%, 100ths of 1%, right? Okay. So here, and as I said, you keep the decimal. You can see here, I'm keeping all the decimals. Okay, you guys see fine, right? My handwriting is good. Okay, so now the question, yeah, I'll get you in 1 second. So this is what is the delta change in price? And we calculate that as a percentage. This is the delta change to price in percentage, right? Based on this calculation, that's the delta change to price in percentage. Then now, what is the actual change in price by dollar? So you take the percentage, you multiply it time the V naught, and it's going to say, well, it's going to be $87 a change in price. It could be up or down. So what is your anticipated, since the interest rate here is actually went down, the price is gonna increase. I'm sorry, the interest rate increased by 1%, then the price is gonna decrease. So you take 1 as a whole. Okay, you remember guys, when I asked you to gross up a number, right? If you said to you, interest rate grew by 5%. So if you invested $100 and it grew by 5%, you'll say 100 times 1.05 become 105, right? You multiply time the increase. You with me, Angela? Here, the price is actually decreased. That's why I'm putting 1 minus the interest rate change. Time the original is going to be the anticipated price, 966.14. You with me, Kevin, or no?
Yeah,
Okay,
just like-
so this is multiple steps. First, we calculated what is the delta change in price. So this is tell us, well, the price is going to change by 8.27%. By 8.27%. This is the price is going to change by. Yeah, this is actually saying the price increase, right? So this number should be plus sign, positive sign, guys. This is positive. Because the price increased by the price increased. Therefore, well, again, in a percentage wise, we're going to keep it in negative. I'm going to tell you why I kept it negative, because you're going to subtract that value from the whole 1. You see here, when I did the 1 minus that a change in price, minus the change in price, the interest rate increased, then the price is going to go down by this, right? The price increased, then the price is going to be decreased by 0.827. If this is an interest rate decrease, then that would be positive, that would be price increase. It's an inverse relationship.
Just make sure in this case scenario, it increase by 1%.
Yeah, it's an increase by 1%. You make sure of that, because here I'm putting here, this is 1% here in the calculation and 1% here in the calculation. Yes,
The price did go down.
the price did go down. Yeah, because the interest rate move up, then the price went down, right? And again, how to keep in mind if it's the price, if the interest rate went down, that number, guys, will be 1.027. You add it to the whole. You with me, John? You add it to the whole. Zach, you good? So if it's the interest rate went down, the 8.27, you add it to the whole 1 as a whole. So it would be 1.0827 and the fraction times the original price. You get that, Sage? Ready, good? Okay, one more time. Here, the interest rate increased by 1%. Hence, the price of the bond is going to decrease by 8.27. So I want to anticipate what is the new price is going to be. So the new price is gonna be, I'm gonna multiply the original price by percentage by part of the whole. So I'm taking 1 minus the 8.27 decrease and multiply times that. If this was positive and the rate was actually decreased, then we say 1.0827 and you multiply times the number. Okay, in your time value of money, if your interest rate increased by 10%, you used to say, I'm gonna multiply it by 1.1. Right? You move from one period to the other is you multiply by 1.1, 1.05, whatever the interest rate change is. But this is a decrease, then instead of, let's say Friday, I said to you the interest rate increased by 5%. Then you say, okay, I'm starting with $100, I'm gonna multiply the 100 times 1.05, right? But if I said to you, you lost 5%, then I can say I'm gonna start with $100 times 0.95. You subtract 0.05 from the whole. You with me? Are we good, ladies? Okay.
Can you explain the rule before how it
Say again?
Can you explain before how if you multiply by 2 in the convexity, that means you don't have to multiply by the half in the change price percentage?
Okay, one more time, John. Is this a previous slide or this slide?
It's with approximate convexity. If you multiply by 2 in the denominator, that means you don't have to multiply by the half.
Right. They go together. So if you put 2 on the denominator, then you don't do the half here. Right? And you just have to follow one or the other so you don't get confused. But I'm just telling you, in your fixed income class or on other textbook, or you might see they actually divided by 2. If you do that, then here you don't have to multiply that by half. You just go in the second step. Because John, to your question, if you divide by 2, that number will be, it's half that number. If you divide it by 2 with half that number, so you don't need to adjust for it. Okay. Move on, guys. So now we answer the question, what is the approximated, what is the expected new price? And based on our anticipated new price, it should be 966. But let's validate. Why does it keep? Let's validate. To validate, so this is an anticipated price, and this is the actual price. To validate, if interest rate move by 1%, up, so it's going to be 15, 8.4, because we started by 7.4, so it's increased a whole 1%. Payment is still 80. The future value is 1,000. Calculate the present value would be 966.58. So this is the actual calculation. One more time here. We're going to go back to our calculator, and we're going to say if interest rate is 8.4, IY, compute present value. So the present value would be 966.5826, right? So this is the actual. But based on our anticipated price from previous slide, we anticipated the bond, assuming we add in the convexity and the duration, would be 966. It's close, but it's not absolutely the same number. You guys got that? But the convexity adjustment increased the adjustment a little bit. So our estimate was, we estimate the price will drop by $86.71. But how much did it actually drop by? $87.15. Our estimate price was $966.14. The actual is $966.58. You guys get the actual? You know how I calculate the actual? Because we're trying to validate that is our anticipated is going to be the real number or not. Keep in mind, we're sitting up front, you are a portfolio manager, you're trying to publish your duration, and you tell your client how much risk they can take investing in this portfolio. In the portfolio prospects, you can put a duration number there for them to read, and you put a duration number up front. But does that duration number and convexity number matches the actual or not? Very close. So when we adjust to the second order, it moved the price up a little bit, and now the price become 966.58, and our anticipation price was 966.14. Hence, we're a little bit off. Now, in finance, they said, well, if we're not absolutely exact, should we consider the third order effect? And you can do that in your graduate school, right? Or when you really want to, you can actually keep, now we went to the second order effect, and then adjust for it a little bit, and we'll find us, we're still a little bit off, but not fully off. And now, you need to account for the second order effect. The third order effect, maybe we should consider. Because convexity is the second order, you may should consider third, but again, that's in this class. Okay, so one more time, what we're trying to do, we're trying to anticipate and calculate how much risk we have in the portfolio we are managing if interest rate is changed by 1%. And we'll start our calculation by calculating the duration, and we'll find the duration failed to account for dramatic change. If it's 10 basis points or 1 basis points, duration is almost sufficient. But when the interest changes become 1%, it failed. Therefore, we need a second adjustment, and the second adjustment was convexity. And when we added convexity, we'll find we're almost getting there, but not 100% accurate. We just a little bit shy. We're 966.58. Okay, let's build on it. Any question? Say again?
Like you have to add the parentheses before the one minus, yeah.
So what is 1 minus this? What is the value you have?
The parentheses.
I mean, you mean like if you do it in Excel, of course. Yeah, yes, thank you. She's saying you need to follow the, please excuse my dear Auntie Sally, right? Right? So you follow that. I agree with you. Okay, I just was writing it down for you to illustrate what is it right. Absolutely. Right, so you do the parentheses first. If you're doing it in Excel, yes, thank you. Are we good? So you guys, what she said is, if you take this number, right, you should put a parenthesis there, so you finish whatever inside this before you multiply it there. So some of you, they do not start with multiplying this first, then subtract this from this, you messed it up, right? To follow the order of operation. So put a parenthesis there, yes. I know you guys more sophisticated than. Okay. Okay, so let's move on to the next slide. But since we're at it, I'm gonna put it there. Thank you. Okay. So now this was a slide I introduced you to the previous lecture. When we said, okay, we need to calculate what happened when we account for a big drop in interest rate. And I said to you that the change in duration when it's 200 basis points, it started to fail. Therefore, we need to add convexity. We estimated to be 33.4, and the actual was 34.25. What happened if we added convexity to our previous problem that we talked about in the previous lecture? If we added convexity to it, you can see the price is actually corrected, and it's 34.25. Let me show you how I did it here. So we work on this slide in the previous lecture, not today's lecture, and we say, well, what happened? This was a semi-annual problem. And we said what happened when interest rate it changed by 2%, and does the duration hold or fail? And we realized that it actually fell because it was not too close. It's not failed, but it's not accurate. here was, we calculated to be 34.25. Is the actual, and our estimate was 33.4. So I went back to the same slide and said, let's add convexity and see what happened. And when you add convexity, you find out the price, it actually adjusts to 34.235. So this is a redundancy to revalidate a problem we did in the first lecture, and this is delta change by 2%. And again, it's 2%, but I'm putting 7 and 5 because here that problem was based on a semi-annual. Therefore, I'm increasing only by 1 in either side. You good, John? You guys are good? Good there? Okay. Now, was the second. Was the you asked that question, John. Then I'm giving you the formula. So this is an alternative notation for your work. Use the previous notation. If you put 2 here, then you're not gonna add. You're not gonna add the half there. Good, Sage? Okay. Here. Here I want to show you. I want to show you what happened in a graph, and I think I showed this before the numbers, and I didn't tell you what all the numbers are about. Is I'm drawing the relationship between yield to maturity when the interest rate change, and I'm drawing a graph for it. And again, you can see obviously here it's based on a convexity, and the relationship is convex. Then how to calculate the approximated duration and the approximated convexity? These are the formula I'm using, which again we are using there. So if you click here on the duration on this formula, will be exactly the same thing we did before. And I'm going to share this Excel sheet with you, so at least some people maybe they like to see Excel and how it's calculated. This is based on if the interest rate is changed by 1%. So if interest rate is changed by 1%, I want to show it to you visually. If interest rate is changed by 1%, this is based on an annual basis. So we can start, I started from the 10%. If the interest rate went down, the price increased, as you see there. If interest rate went up, the price decreased. And the delta change in the price is minus 8.69%. So the delta change in the price minus if the interest rate went down by 1 or the interest rate increased by 1. If interest rate went down by 1, the price is going to increase by 10.27. So let's calculate what is the actual. You can see the actual price when the rate went down, it becomes 1102. 1102. So I said we predict if the rate dropped by 1, the price, the new predicted price, and this is just to validate my formula. We're starting with 1,000, and we're gonna multiply that time 1.1027, right? Because it is the percentage change in the price. is going to be 1102.7. So our predicted formula on a change in price by 1% is about almost the same. You guys see that? You guys, anyone not sure how I did that? So this is our calculation. This is our calculation. Our calculation said if interest rate drop by 1%, here, delta change in the price 1%, you're gonna get a gain of 10.27. This is the start point. So how much we calculate the gain? We said $1,000 times 1.1027. It's gonna be 11.27. So this will be our anticipated price. But what was the actual price? 1102.74. You got that? Right? Okay. Now what happened if interest rate increases, the price is gonna drop by 8.69. How we calculate the price 8.69 drop? So guys, let's do this with me. 1 minus, let's do it. 1 minus 0.0869. So 1 minus 0.08, we're gonna change it to decimal, 69. What is the value you got? What is it?
0.913.
Thank you, Freddie. Can you multiply that times 1,000?
913.
Right, so this is our anticipated. Is it exact 913.06?
No, it's 0.1 for me.
Right, okay. So you can see now that our predicted value and our actual calculation, they come in very close to the real number. You good, Eric?
Yes.
Okay? Any question there, guys? Okay, so now we get a good flavor of fixed income calculation and risk associated